All right, so something happened on Friday that we've been waiting very patiently for, and it finally happened. So we got the jobs report out on Friday. And as a result, we're hoping that this is the unlocking of the mortgage rate free fall, is what I'm calling it. And so we saw a big decline in mortgage rates. And Steve, this is what you and I have been talking about for a couple of months, that the jobs report to show what we're going to show the audience right now will be the last thing that has to happen for us to see mortgage rates come down. And yes, people have been calling us crazy, but it's finally starting to happen. So let me show what's going on, and then we'll get into it. So Friday, the jobs report comes out, okay? And this is a report that Dr. Lawrence Yun, who is the chief economist for NAR, did a report on Friday. And what he said was this. He said the 30-year fixed rate mortgage will stick at 7% range for this year, but looks to move down into the 6% range by the spring of next year, which is going to be amazing. So here's what happened. So the monthly job gains softened like crazy in the month of October. We thought we would see this in September. We'll come back and talk about that, right? We talked about that a little bit on the last episode, but it came way down as a result in October. Then unemployment also is starting to creep up a bit, which is what we said this entire time. As soon as unemployment starts to increase, the bond market will respond accordingly and mortgage rates will fall. Well, that's exactly what happened. As wage growth, right, it's the weakest in 2.5 years, as that starts to go down, the 10-year Treasury responds by also going down, right? And so what happens as a result of all of this from Friday, mortgage rates, we're finally starting to get some relief from mortgage rates. So why don't you just take a minute, Steve, update us on like the impact it had on rates and kind of where we're at, and then we'll start to talk about what things look like moving forward.
For sure. So yeah, we finally, there's a couple things to be said, right? We're finally starting to see some softening in the labor market. And a big part of this has to do with the way that some of these numbers are seasonally adjusted, right? And so if you really dig into the nitty gritty of this jobs report data, which has really been pushing the market and driving the Fed's decision making, is when you really dig in and see what that actual data is, what jobs are being created, how many people are actually in the market looking for jobs compared to how many are not in the market looking for jobs, and that goes into that employment percentage calculation, is that this has been softening for a long time. And it's just going to be a matter of time where the raw jobs numbers start to play into that market. So last week we had, for a long time, and last week was the first time we've had kind of information compound, right? So lately it's been information compounding against us, whether it's bank failures and treasury issuance and like all these different things flooding the treasury and bond market with supply, which means that you have to raise the rate of return to create liquidity or for people to buy them. We're starting to see that move the other direction now. And so on Wednesday, we had the Fed meet, which had a slightly softer tone. They said that they acknowledged that bond market was quite restrictive on its own without them making any additional moves, that financial and credit conditions were very restrictive. We saw the JOLTS report come in, which is the job openings, was a little bit higher than expected, but it was still around 9.5 million, which is not a bad number. Thursday, we saw unemployment claims, and this was a big driver because we saw the Fed have a little bit softer tone on inflation and on restriction. And then on Thursday, we saw unemployment claims tick up a little bit higher. We saw continuing unemployment claims tick up higher than expected. And then obviously Friday, we got the jobs number, which came back in lower than expected. And then we also saw revisions for the last 2 months reports decrease those numbers by over 100,000 jobs created. So we're starting to get some of those wins. Now, is it going to be something that, people should keep in mind as they watch this? Like, rates had a really nice move. We gained probably 5/8, realistically like 0.5 to 0.5% drop in rates between Tuesday and Friday, which was one of the biggest decreases we've seen in a long time. And it's refreshing coming off of 8% or 8.033 as it was reported. It's going to be a bumpy road. We still don't have, it's for the Fed to really get excited and even talk, even to say the C word, which is cut. Don't get it wrong. Here in our world. And for them to even say that is really going to have to take a couple months of this kind of compounding of these figures.
Yeah. Well, let's look at that for a second. So you're exactly right. And so when we start to look at the month of November and we say, okay, well, what's happening in the month of November from an economic standpoint that will impact mortgage rates? We say, okay, so we just got Friday, we just got our unemployment report, right? We just got the jobs report. But then on the 14th, we have CPI coming out. And I want to talk about these in just a second, right? So let's stick on CPI and all of these other economic reports that are coming out here in literally next week. What are we expected to see as it relates to these inflationary reports?
So CPI should come in our favor. That one is, so consumer price index, that headline inflation number is driven heavily by the prices of oil. And so if anybody here gets gas that's watching this video, you've probably seen that gas prices have been coming down some lately. In some cases 50 to 60 cents a gallon, which if you really look at it, that's like over 20% savings in fuel. So there's two numbers you look at in CPI. There's core and then there's headline. So core CPI pulls out the price of fuel and the price of food. However, the fuel does start to trickle. The price of oil does start to trickle into like the core inflation number. So we should see a good bit of relief on the CPI figure. We should see the PPI, which is a producer price index. Both of those, based on that information and what we're seeing for some rental information that we saw late last month, all of those things should come in favorably. That will continue, this tone of inflation, like the growth rate of inflation is what we're looking at now. Inflation's not going away, but it's how much, what is that growth rate? Was it 11? It was 11% or 9% or whatever. I don't even remember the peak anymore. And now we're looking at it closer to like 4%, 3.9%. We're looking for that growth rate to continue to fall. And everybody knows that's the hardest part, is this last step, but we're getting there. And so we'll see some more information on that this week. We'll also get unemployment claims on Thursday, which is a weekly number. And we're looking for that average to continue up. Ideally, it'd be nice to see it, starting to crest closer to 220,000. Above that would start to be something that the markets would get excited about. We also have Jerome Powell has two speeches this week too. So there'll be because the Fed meeting was last week, there'll be a lot of Fed governors and Fed members speaking this week, just in interviews and stuff like that. So when there's no real economic data to drive the market, they're going to take every word out of these guys' mouths, as gospel, which will be kind of interesting to see.
Yeah, you're right. Because every time he talks, right, markets respond based on what he's saying. So do you have any insight that you might be able to share with the audience on how you think his tone will be this week?
I think he'll stay the same as he was in the press conference. He'll acknowledge that, that employment report was the direction they want to go, but they're going to want to see more. He mentioned it in his press conference that they need to consistently see figures move in the right direction for them. So I don't think his tone's going to change tremendously in there, or that he's going to make he's pretty measured with these things. And the last thing he wants to do is create a party in Wall Street before, prematurely. So I think that his tone will be about the same as what it's been. We're going to continue our fight at whatever cost to get inflation back to 2%.
Yeah. Which again, it's working. I think that if he can speak to some of the recent events, and take the tone of like, hey, look, some of the stuff is starting to work, then will that give the market perhaps the confidence that it's looking for?
For sure. And I mean, look, there's a few things that are going to drive rates here too, and that's why it's a rocky road, right? It's not going to be a linear descent, right? It's going to be up. Like we could go back in 2 weeks, we could be back talking about rates at 8%, and then they could come back down again. It's very, very volatile. Hopefully we don't, but it's very volatile. And so there's a couple things in here that we're watching, right? So we're watching the 10-year treasury. We're watching these unemployment figures. The other thing that you mentioned, you didn't mention it, but it was in that first Lawrence Yun blog that you posted, but the spread between the 10-year treasury and the 30-year fixed rate is the highest it's ever been. It's about a 3-point spread between the 10-year treasury and the 30-year fixed mortgage. So if you go back up and you see, keep going. It's in his statement, in his words. So he just says right here, So it says, moreover, if the spread between, under this highlighted part, moreover, the spread between the treasury and the mortgage were removed from normal highs to the historical average, rates would already be in that 6.2 to 6.7 range. So there's some holdback there. And again, that spread will come down when we actually get that language from the Fed. So the Fed's not going to have to cut rates for us to see rates drop. It's going to be the Fed saying, we are happy with economic data. These are trending in the right direction. And in the next couple meetings, we will start the conversation about slowing down these restrictions or cutting rates. As soon as that happens, we will start to see that spread come down between rates. And that will move the market faster than them actually cutting rates.
Yeah. I mean, great point. Thank you. I can't believe I almost missed that. That was the whole point. That was the whole point of like where this is why you and I were projecting rates to be a lot lower right now than they are, because of this exact point. And
everybody did, though. I mean, everybody did. Every single, like, this is completely abnormal to have those spreads. And there is and it goes back to the supply of treasury. There's such a perfect storm of supplies for these treasuries. Another thing that happened last week too that was really big news is Joshua Frost, who I forget what he is. I think he's like the vice president of the Treasury or assistant head to he works just below Janet Yellen. And so our federal government, after we had the last spending plan passed, it's now time for them to borrow some more money. And what they've been doing in the past and what the market feared was that they were going to continue to borrow that money in long-term treasuries, like 20-year and 30-year treasuries. And that market has been just getting absolutely obliterated. So this guy finally is starting to this guy should never be in the headlines, by the way. This is like totally behind the scenes guy, but he made the move of saying, so there's treasury notes, there's treasury bonds, there's all kinds of different things that you can buy in the treasury market that mature in different ways. And rather than borrowing on those long-term treasuries that we've really been getting hammered lately, he made the decision to borrow that on a shorter term. And that has helped that treasury market immensely. That pulled, there's a lot of fear that was going to be another huge supply that comes into this market where there's all these bonds that need to get bought up. And he bought them, he borrowed that money in a different way. And that helped the bond market a lot also.
Are you guys related?
No, I wish. I'd call him up. I'd be like, remember?
That's what I was going to say. Did you call him up and say, hey, can you do something for us? And then he made that decision last week, or
that had nothing to do with me. I tried. I reached out on Instagram.
Yeah.
Shut me down.
So the whole point of today's episode, Steve, is that although it's been really tough this year for sure, right? When it comes to transactions in the housing market, home prices are still staying, they have not fallen, right? So that's number one. Wow. Number two, mortgage rates have been super stubborn until I think some of the recent activities that we covered in today's episode just last week. And I am under the belief that as we move forward, well, the meetings from Jerome Powell this week, I think, will be a huge thing. Do you know what days those are on?
I think he's speaking twice today, and then he might be done after today. I know he speaks twice this week. I don't have the actual dates, so we'll kind of see. It's gonna be a rocky road, but ideally, this is the information from last week would be ideal to keep going. And again, it's not like when people think about rates dropping, it's important you remember that, like, we're hoping to get rates at like 6.375, 6.5, maybe close to 6%. This isn't a race back down to 5% or 4% or anything like that,
And we don't need them to. No, we don't need them to. So we have annualized transactions still at like 4.1, 4.2 million. Mm-hmm. So people are still buying houses. In fact, you and I just met last week. We took a walk, and you and many other people are having some of their best months ever when interest rates are the highest they've been in, over 20 years. And
Yeah.
in a market where, transactions are down 20, 30, 40%, people are still doing well, which tells me that people that are committed to this business can still do extremely well. And then to your point, we don't need rates to go back down to 4%. I believe if we see rates come from, 8 to 7.5, which is kind of where we're hovering right now, and we see rates at 6.5, 6.75 next spring, that is enough to really get this market moving, where we could potentially see in 2024 a market where we go back to 5.5 million home sales.
For sure. I mean, the statistics say that there's every 1% that rates drop, there's another 5 million buyers in the market that are ready to buy. I mean, there's a lot of money on the sidelines right now that just they can't get over, the hurdle of taking on some of these higher rates. But I mean, I have never seen it's been a couple of years since I've seen clients getting concessions and getting good deals on properties that we're never going to get them at any other time. So it's been a good month. Having these higher rates take people out of the market is not a bad thing if you're a home buyer right now.